If you're thinking about buying a home or investing in real estate, then you need to understand what's happening with interest rates, home prices, and inventory right now. Because the biggest factor in today's housing market isn't just supply and demand, it's mortgage interest rates. So what does this mean for you? And how will it impact your ability to buy a home or invest in real estate? And what's coming next for the market? This is exactly what I'm covering today. So let's start with what's happening right now. Today, there's just over 1.5 million homes for sale. That's up 13% from last year. Sounds like good news, right? More homes, better deals? Not exactly. Before the pandemic, inventory was closer to 2 million homes. And we're still well below normal levels, which means buyers don't have as many options and sellers hold most of the power. After all, less inventory means more competition and higher prices. Let me explain. Right now, the market has about 4 months of inventory. Now, a balanced market where supply and demand are roughly equal usually has 5 to 6 months of inventory. And this is the point where neither buyers nor sellers have the upper hand. Now, for buyers, more inventory means less competition and better negotiating power. And in a perfect world, buyers want to see inventory closer to 6 months because that's when price growth tends to slow and they have more leverage to negotiate. So with where we're at right now, at just 4 months of inventory, we're still in a seller's market in many areas. Inventory has improved, but not nearly enough to bring prices down in a meaningful way. So if you're a buyer waiting for prices to come down, the current lack of inventory in today's market is one of your biggest obstacles. But the real story here isn't just about inventory, it's about what mortgage rates are doing to the market right now. Mortgage rates have been bouncing between 6 and 7% recently, but let's break down why that's happening, because it's not as simple as the Fed just flipping a switch. Here's the deal. The Federal Reserve doesn't directly set mortgage interest rates. Instead, mortgage rates are heavily influenced by the bond market, specifically the yield on the 10-year Treasury note. When rates fall or climb, it affects short-term borrowing costs for banks, which ripples into the bond market. And mortgage lenders use the 10-year Treasury yield as a benchmark to price 30-year fixed-rate mortgages. And this is exactly why we saw rates drop briefly coming into this year. Now, a few months ago, investors were expecting multiple rate cuts in 2025, which pushed bond yields down and caused mortgage rates to dip. But then guess what happened? Inflation reports came in hotter than expected. So investors adjusted their expectations, and now the market believes the Fed will cut rates fewer times than originally expected. So that caused Treasury yields to rise again, which pushed mortgage rates right back up. Now, I know this can get pretty confusing very fast, but the bottom line is this. Mortgage rates will stay high as long as inflation remains sticky and the bond market reacts accordingly. Until we see clear, sustained progress on inflation, we don't expect rates to drop significantly anytime soon. And as long as rates are high, don't expect inventory to ease. Not a lot of homeowners out there want to trade their 2% and 3% mortgages that they locked in over the last 5 years for today's higher rates. So the next question is, where are rates headed next? Well, I wouldn't expect them to drop below 6% this year. In fact, it's a pretty high likelihood that they hover around the mid-sixes, maybe between 6.3% and 6.7%. Inflation's looking a little more stubborn than anticipated, so it's asking too much of the Fed to cut rates aggressively. Now, could they go lower? Possibly, and there's even a chance that they go higher. Now, a weak economy could bring rates down faster, but as long as the US avoids a recession, don't expect a massive drop. Now, if the economy stays strong and unemployment remains low, demand for housing will keep mortgage rates elevated. Look, nobody has a crystal ball, so this is all just a fun thought experiment. But something I can say with confidence is that for now, the days of the 3%, 4% mortgage rates are probably over for the time being. Now, I know that's not what people want to hear, but that's the state of today's economy. So if you're sitting on the sidelines waiting for rates to drop that low, you could be waiting a very, very long time. And that leads us to the next question. What do these interest rates actually mean if you're looking to buy a home or invest in real estate? For starters, the golden handcuffs are real and keeping inventory levels suppressed to a certain degree. And this is because millions of homeowners locked in mortgage rates at 3% or lower over the past few years. So this means if they sell today, they'd have to take on a new mortgage at 6 to 7%, which doubles or triples their monthly payment in some cases. So then what happens? Well, then some of these sellers aren't selling when they don't have to. They're staying put, which is keeping inventory at a lower level and prices high in many markets. Now for buyers, this means fewer homes to choose from, tougher competition in some markets, and less room to negotiate on price. For investors, this means buy and hold rental properties are still in demand. Long-term appreciation is likely, and even if growth slows, it's still very likely. But it also means that the investors who are willing to work on their negotiation skills will always still be able to find great deals. Now, if rates do end up falling under 6%, it's safe to assume more retail buyers will be able to afford homes again. And then here's what happens when more people buy. Prices go up. So once again, if you're waiting for both lower rates and lower prices, that's probably not going to happen. And I've said it before and I'll say it again. Trying to time the market perfectly is nearly impossible. If you wait and rates fall, prices could rise, meaning you didn't actually save money by waiting. But if you buy now, then you have options. For example, if rates drop, you can then refinance in the future. If prices rise, you build equity faster. And then you can even lock in today's prices before potential competition picks up. So in the end, locking in deals at today's prices could be a smart move, especially if rates ease in the future. So now that we've touched on interest rates, let's see how that translates to future home prices. Most experts anticipate modest home price growth of 1% to 3% in 2025, and I tend to agree. The current state of the economy, inflation, and the Fed's hesitation to cut aggressively doesn't really leave room for prices to crash or surge higher. Instead, the housing market will likely continue on a slow, steady path, similar to what we saw in 2024. So for the first half of 2025, I wouldn't expect anything out of the ordinary. The market will likely move at the same pace that we've seen, with mild growth, moderate demand, and limited supply keeping prices from falling. However, when it comes to the second half of the year, things become much harder to predict. And why is this? Because there are too many unknowns. We just don't know how the new presidential administration will shape economic policy. We don't know how the Federal Reserve will respond to inflation and rate pressures, or how global trade and financial markets will impact interest rates. And these factors could shift market conditions significantly. But until we get more clarity, my forecast remains unchanged. 2025 is shaping up to be another steady year for the housing market. Now, at the end of the day, the right time to buy a home isn't when the market says so. It's when you're actually financially ready and able to buy. Because if you wait for rates to drop, then prices might go up. And if you wait for prices to drop, then you might never actually buy. So if you can afford a home or if you can find a good deal on a great property, go for it. And for real estate investors, the opportunity as always is to lock in good deals before potential competition heats up. And the truth is, timing is really about being active all the time. The vast majority of opportunities cannot be taken advantage of from the sideline. You must be active in the game and close to the action in order to find the good deals. So as an investor, this means you have to be consistently searching for deals that fit your criteria and ready to submit offers quickly in order to get the great deals under contract. And so from actually being in the game, from being active and submitting offers is how you will be able to actually get great deals in this market. Now, if you found this helpful, make sure to like and subscribe, and I'll keep you updated on the housing market, mortgage rates, and investment opportunities so you can always be ahead of the competition. And if you're serious about getting into real estate, whether it's investing, wholesaling, or flipping houses, check out realestateskills.com for free training and expert guidance. Thanks for watching. I'll see you in the next one.